Thank you very much, Fernando, Mr. Micunier. It's a great pleasure to be here today and to open your conference on these extremely important themes, bank resolution, crisis management, and deposit insurance. And what I'd like to do to start off is to take a deeper look at the theme of resolution, at the theme of too big to fail, and pose the question, where do we stand? How far have we got 10 years after the necessity for this work became so obvious? I think if I'm right, the third chair of the FSB's resolution steering group, which has overseen the work to try and tackle the obvious deficits in resolution and resolvability, following on from Elke Koenig and Paul Tucker, who I see sitting at the back, and probably could be called the inventor of bank resolution. Or I think 10 years ago, resolution was something you didn't do to banks. You did on the 1st of January, and by this time in the year you'd forgotten it, or it was done at the United Nations to limited effect. Bank resolution was something we didn't talk about 10 years ago, and you know, the work that Paul initiated with a huge energy and passion has got us a long way. I'll ask the question, how far are we, and how far is there still to go? But I do hope that, Paul, that we have protecting and developing your legacy adequately. Looking back 10 years, as Fernando said, I can remember where I was 10 years ago. Was working in the private sector in a bank that was unwittingly on its way towards some kind of resolution. A bank that at the time, at the end of 2007, and we're talking about UBS, was the third largest bank in the world by balance sheet. It's interesting, I looked at the largest banks in the world by balance sheet at the end of 2007. They were, I think the largest 5 are all European. RBS, remember, RBS had a balance sheet of $3.8 trillion at the end of 2007. UBS was the third largest bank in the world at the end of 2007. They were banks we called global titans. There was a Dow Jones Global Titans Index. We now call them GSIBs because we name them for their risk and no longer for their strength. The world has changed. The 4 biggest banks at the end of 2017, 10 years on, are all Chinese. Interestingly, the size of the 4 biggest banks in the world are roughly the same as the size of the 4 biggest banks in the world were in 2007, but they're fundamentally different banks, and those who led this particular league table then are in fundamentally different shape and went through all extremely difficult times. So when we look back, we know the damage that was caused by the financial crisis and its repercussions. That needs no repeating. We know the reasons that led to such a deep crisis among the largest banks in the world. We know that it was because of the leverage. In the case of the Swiss banking system, leverage that peaked at around 40 times. You know, so when we talk about leverage ratio, we talk about 2.5, 3, up to 5%. But when you think about how highly leveraged the balance sheets were, we're talking about 40 times for a banking system and way more than that for the largest banks in a small country. You can see what kind of a vulnerability had been built up. A vulnerability that made the system extremely sensitive to the smallest errors in risk measurement. So the second reason for the crisis being as it was not just the build-up of leverage, but the faulty risk measurement and a small faults, relatively small faults proportionally in the risk management, risk measurement could, as we know, wipe out the small amounts of capital that were available in comparison to the balance sheet. the use of and the overuse and the aggressive calibration of internal models as part of a generally light touch regulatory regime which had been accelerated by the implementation of Basel II. Basel II was well meant. Basel II was, in a way, intellectually and almost scientifically justified, but had the effect of taking capital out of the system at exactly the wrong time. And the 25 to 30% of capital that was taken out of the reserves of the largest banks in the world would have been very useful in the crisis that then hit very soon afterwards. So we know, or we think we know the reasons. We also know the response. If Basel II was the culmination of light touch regulation, Basel III has been the response. It's created indisputably a banking system with much more and better quality capital. If you look at the largest banks in the world, they're running with capital ratios which are better defined than they were, which are around 3 times what they were before the crisis. We've reduced the connectivity in the system, in particular with the derivative reforms and the reforms to the financial market infrastructure, and we've set out to tackle too big to fail and increasing the resolvability of the largest institutions, which is the theme that I would like to spend more time on today. Before I do that, a quick warning from my side based on what I've just said. If Basel II sowed the seeds of the crisis or helped to sow the seeds of the crisis, Basel III and the work around it, the surcharges for large institutions, the build-up of resilience we've seen in those institutions has been the right answer to the crisis. We need to finish that job. We're a long way along that path, but the most important thing is we finish that job. We preserve the resilience that we've built into the system, and we do not roll it back. We can see now that the new global titans, the banks that are beginning to thrive in today's economy, can operate successfully with the enhanced robustness and resilience that has been built into their balance sheets through the regulatory intervention. They can operate successfully at those levels, and they should operate at those levels, because as we learned in 2008, if it goes wrong, these institutions don't just harm themselves, they harm all of us, and therefore it's the time now to stay firm and appreciate the achievements that we've made in building resilience into the banking system. If I focus now specifically on the question, how have we been doing in improving the resolvability of the largest institutions? And I will focus today on the largest institutions. We can ask the question, we can come up with our own answers as policymakers. We can also have a look at what the market thinks and take some signals from the market. First and foremost, we should probably look at the debt market, because it's the debt market that should be most concerned with the resolvability of the financial institutions that they're lending to. We have institutions now, as I've said, with much higher level of resilience. They have capacity there in the going concern capital. They have capacity building up in gone concern capital. They have higher liquidity buffers. What does the market think about their resolvability without the necessity of state support, and in particular state capital injections? If you look at the one way of looking at that is to look at the way rating agencies monitor the banking sector, and there we get a not exactly concrete and unanimous answer, but a directional answer. Whereas leading up to and in the crisis, rating agency notching for state support was up to 3 notches. There's no rating agency in the world now which delivers more than 1 notch for state support over and above the standalone ratings of banking institutions. One rating agency has taken all the notches for state support out of their ratings. One has them in for certain parts of the capital structure, and one has generally a 1-notch uplift for large banks, large systemic banks in the most important jurisdictions. So what we've seen is a reduction in the view of the debt market as to how likely it is that state institutions and governments are going to have to intervene and support their banks in crisis. If you think about what that means, you also understand why this work is so damn difficult, because what I've just illustrated is a measure of success in improving resolvability, which is based on reducing the quality of the rating of the institutions, or that part that's dependent on state support. And obviously, losing those notches means either raising funding costs through having a lower rating, or having to do something else to increase the resilience, which also costs. So resolvability is clearly not a free lunch. Resolvability costs because, if you like, in a very crude way, improving resolvability is designed to take artificial elements created by implicit state guarantees out of the funding and reduce the funding cost advantage of systemically relevant banks enjoyed in the past. So there, the answer is we're not there at the end of the journey, but there is evidence that the debt market is more convinced that the public sector will need to do less to resolve these institutions than in the past. If you think about signals from the equity markets, which are not directly relevant because equity markets expect to lose their investment in resolution, but there is one interesting theme there that I'd like to touch upon, which is all of this resilience that has been built into the banking sector doesn't yet seem to have had an impact on how the equity market demands to be compensated for the cost of for investing in large systemic banking institutions. The cost of equity that the market implies for large banking institutions seems to have remained relatively stable, and this is a conundrum that a lot of people have puzzled over. Why, with all this extra resilience in the system, is the cost of equity implied for a large banking group somewhere stubbornly in double digits, and therefore the equity risk premium that's applied to these activities is still high. It suggests that the equity market does not trust that the benefits to the stability of the banking system from this increased resilience are robust or fully realized or sustainable. Why is that? Well, maybe the market has not forgotten what happened 10 years ago and has not yet developed a trust that the largest banking institutions are fundamentally more stable than they were. What does that mean? And if you think that the role of bank management, often the self-appointed role of bank management, is to deliver returns on their equity that exceeds their cost on equity. If the cost on equity is stubbornly high, despite the extra costs of increasing resolvability, there's a pressure to deliver returns, which loops back into a pressure on the regulatory constraints on doing business, or on some of these extra costs of the resolvability. So it's no great surprise that we're in a phase where there's a hefty debate on what exactly is necessary to secure the resilience of these institutions. Where do we stand on the final piece of the puzzle of resolvability? If we're convinced that the buffers that we need on the capital side and the liquidity side are either have been built or are being built. The final piece is the planning for resolution and the ability to execute a resolution with the absence of unnecessary state support. My feeling is that where we stand now is at a point, especially where banks are concerned, where at the policy level, we're largely done. There is tidying up and there is fine-tuning of some of the policies that have been put into place. But if you look at the work plan of the resolution steering group going into the next couple of years, while for CCPs and financial market infrastructure, we're still trying to work out what resolution means and how that should find its way into policy internationally and nationally, while for insurers we have actually no idea what systemic relevance means anymore, and we've got ourselves into a mess. For banks, a lot of the work is already beginning to look back at what has been done and look analytically across the globe to see how well things have been implemented. We're not at the stage where we need to develop large chunks of new policy, but we are at the point where we have to understand whether these policies are going to work. And I think that's exactly the point in time we're at. How convincing are we, or how convinced are we that what we've set out to do is actually going to work when we hit the next major crisis for one of the of these large global banks? It's clear that the buffers that we built up are there, and they're large. Some estimates I've seen that up to $1.5 trillion of gone concern capacity has already been raised over the last years, on top of the increased equity buffers in the institutions. If I look at the Swiss banks, and as I said, UBS in 2007 was the third largest balance sheet in the world of $2.5 trillion. Now has a balance sheet of somewhat under $1 trillion, and against that $1 trillion balance sheet has 40 billion of going concern capital, the vast majority hard equity capital, CET1 as we call it, and another 40 billion of recently raised explicitly bail-inable debt capital. So you're talking, and the other Swiss GSIB has a very similar balance sheet structure right now. So you're talking about loss-absorbing capacity for these two institutions of around 80 billion, talking Swiss francs, 80 billion on a balance sheet of around $1 trillion. The most troubled bank in the crisis, in the last crisis, didn't manage to lose more than about 50 billion on balance sheets, as we said, that were running up to over 3 trillion. So just the sort of smell test of have we built enough capacity, we seem to be getting into the zone where we can feel more comfortable. The question is, are we going to be able to deploy that capacity when it comes to the crunch? And are the plans that we have for deploying that capacity really going to work? There we're talking about the hard, detailed work around making resolution plans concrete. And when I say concrete, I mean something which is robust and is going to stand up when it's tested, not how detailed is it. There's a trap in resolution planning of being obsessed by the size of the resolution plans and the amount of detail they contain. We all know that crises will not run how they're set out in the playbook. And our view of resolution planning from a Swiss perspective is, if you can't write it down, read it and understand it in something that an average executive can digest in half an hour to an hour or so, you haven't got a good plan, because it's those executives, together with our executives, who are going to be trying to execute that under extreme pressure. So the questions beyond have we got the right amount of capacity is the statute in place in all the jurisdictions that means that legally the techniques that we want to deploy will actually work? So if we're relying on single point of entry bail-in as a primary resolution strategy, are all the legal competencies in place to make that work? Because that means doing painful things to categories of creditors who in every past bank crisis were protected. And it means triggering the write-down or the conversion of instruments which have not been tested in crisis before. And the other key question for a resolution plan that we ask ourselves is, if in the case that may not work or that may not deliver enough capacity despite everything we've built up, what are the alternatives? Are there alternatives in terms of being able to break up these monolithic groups into segments which can be protected, wound down, or resolved on a local or segmental basis? This is very difficult work, as I said, because all of this work, to be adequately prepared, also costs. You're talking about restructuring large global groups. If I again use the example of the Swiss banking groups, one of which had a almost totally branch-driven structure where the $2.5 trillion I talked about was essentially running on one global balance sheet. Those institutions are now modularized with holding companies at the top of the group and subsidiaries in all of the key risk-taking jurisdictions, which are to some extent ring-fenced from each other. That's a massive program of work, and it's not surprising that it's taken us a long time to get to where we are. Where do I think we are with the executability of these plans? I think that only a few of them will work in all circumstances. We have not got to the point in our jurisdiction where we're prepared to say, yes, these plans will work in all of the plausible crisis scenarios which may occur. We saw at the end of last year that the largest US firms have had their resolution plans approved or declared plausible, and that's the first jurisdiction in the world that's taken this step to say we've gone there as far as we can go in the planning phase. One technique that we have, or one tool that we have in our jurisdiction to incentivize resolution planning is a rebate on the gone concern capital requirement for the GSIBs. And last year, based on status at the end of 2016, we felt we were able to give a third of the possible maximum rebate to our largest institutions. So a third of what they could achieve if they put themselves in the ideal state of resolvability. And that, how you interpret that depends on whether you're a glass half full or glass half empty type of person. We've come an enormous way along the road since 2008, but there are still a lot to be done to be convinced that we've given ourselves the best chance of executing on the tools that we've given ourselves. So what more needs to be done? As I said, the policy development on an international level is largely complete. That doesn't mean that all the tools that are required to comply with that policy are in national statute all the way around the world. So there's still legal implementation that needs to be done. But even more importantly, there's the work that we as resolution authorities do with the firms themselves to make sure that the plans are in the state where they can plausibly be executed, and when we have alternatives in place and a toolkit that can be deployed in unexpected scenarios. So we still have to ask ourselves for all the largest banks the questions that we ask the banks themselves when we look at their control systems is, how does the design effectiveness look? And then at some point in the future, we'll be testing the operating effectiveness one way or another. The design effectiveness of the resolution plans is, can they work? And then the operating effectiveness of the resolution plans is, will they work when they're tested? And what is important to, if you like, convince us all and convince the market that we've done the maximum to remove the too big to fail problem from the landscape, is that we can positively answer both questions. Not just that the tools can work, but that the tools will work. And as soon as you drill down into what is underneath that last question, you realize it's complex and it's political, because we're talking there about executing, as I said, tools which will be to the detriment of creditors who maybe didn't realize that they were going to be involved in a restructuring, and will be setting precedent, and will be affecting the way markets price the risk that they're prepared to fund. So it's important for the credibility of bank resolution regimes across the world that we begin to build up a track record of successful use of the tools that we have, and that we're not faced at the end with if you like, a political discount on the credibility of resolvability, where in the past we had a discount because of the capacity and the technicality and the lack of implementation progress. We've got to be in the position to prove that when we say bail-in is the right way to resolve a lot of groups, that we are prepared to do it, and that we're prepared to make that part of the normal process of allowing large banking groups to exit the market. And I think answering these two questions positively, can the plans work and will they work, is the key to leaving the final question to the market, and getting back to this question of how the debt market views the institutions they're funding, allowing them to discipline the institutions, because it's that discipline from creditors and depositors which fundamentally has been missing from the capital markets in the past, and that will be key to driving the right degree of risk awareness and risk return judgment into bank managements in the future. And only then will we be able to say, not that we've solved the problem, but that we've done all that we reasonably can to solve it from a policy and the regulatory perspective.